All right, this is account 200. We're still in chapter 2. Now we're on objective 2.3, and actually we're going to blow through this one and get straight to 2.4. So show the impact of business transactions on the accounting equation. Your textbook does this thing where they have assets equal liabilities plus, I'm going to abbreviate S/E for stockholders' equity. And then they show cash up or cash down. Cash goes up, and then they show a liability, like we say accounts. Let me get this eraser here. They have something like AP is accounts payable down. Well, that would not be the right. Excuse me, that is not the right transaction. Cash goes up. You might have like common stock. If you issued stock, common stock go up, cash down, then you might have accounts payable go down, something like that. I don't want to get hung up on this because even though it is true, every transaction will always maintain the accounting equation. I don't want to get hung up on this format because it's not the way we're going to actually do the accounting. It's not the way the accounting is actually done. So if you get too hung up on the format, it'll actually be a little bit confusing. So I want to go straight to 2.4 onward. We're going to talk about journal entries because that's how real accounting is done. Whoa. Oh, that's the problem, guys. I had this touch thing on. Okay. Sorry about that. It's a little feature of this tablet thing I'm working with. All right. So, objective 4, analyze the impact of business transactions in the accounts. This is, on this slide, I just have lined up a process for analyzing every transaction. So the first thing that would happen is the accountant would review the transaction under GAAP, and you're reviewing it, and you're thinking, does it belong in the accounting system or not? So either it does not, and then it has no impact, and you're done, or the transaction is going to enter. So let's go down to here and say it enters the system. Okay, we determine that it's going to enter the system. Well, what we have to do is specify the account. So when you're doing a transaction, you're going to identify the accounts impacted, and you're going to give a side, a giving side, and a receiving side of each transaction. Then you're going to determine the amount. So first, you have to get the right accounts, determine whether they're increasing or decreasing, and then assign amounts to each separate account. All right? And finally, when you talk about the impact, you might also look at the net impact. So you're going to look at how the accounts in the transaction, how they're classified as asset, liability, or stockholders' equity. And if they're classified the same, in particular, you may net them out. So let's look at an example. So example analysis of transaction. So here they're going to purchase a $50,000 truck with cash. So Mohan Incorporated purchases a $50,000 truck with $50,000 in cash. We're going to review the transaction, and they determine that the transaction should be recognized. So this is a normal type of transaction that enters the financial system. So that's our determination. We specify the accounts. First, there's a cash, which is an asset, and a truck asset. We could use the general title, property, plant, and equipment, but as long as you have truck, I'm okay with that. As we get into the semester, you may use that shorthand. And now we have to determine the amounts and whether they increase or decrease. So we pay out cash, so there's a $50,000 decrease to cash, and we get a $50,000 truck, and because of the historical cost principle from Chapter 1, that's how much we transacted at, we're going to increase the truck asset by that amount. Now, if they are classified the same net amount, they're both assets. So assets went down 50,000, decreased 50,000, but then assets increased 50,000. So total assets don't change, total liability, stockholders' equity doesn't change. It's just an exchange of one asset for another. The only change in the financial statements is an increase in property, plant, and equipment and a decrease in cash. So this does decrease the current ratio, current assets to current liabilities, but there's no effect on the financial statements totals. Okay. Now, that was just doing some conceptual analysis. We have a framework in our accounting system for kind of more systematically representing the numbers. First of all, the accounting equation is never violated. Okay? And debits always equal credits. In fact, the system ensures that the accounting equation won't be violated when debits equal credits. Debits and credits keep track of increases and decreases in assets, liabilities, and stockholders' equity. Debits and credits will keep the accounting equation in balance. All right, now what is a debit? A debit is a left entry and a credit is a right entry, which is why I keep using the big red R. If you can remember, credit is a right entry, then you're done. Debit's the other side. So seriously, this is not a joke. You absolutely have to remember that a debit is a left entry and a credit is a right entry. Okay? Here's an example using a T account. And an account is a basic summary device, so this is summarizing cash. A T account is just a kind of a smaller depiction when you just want to look at a specific part of a bigger account. So let's say they began with 120,000. Cash has a debit balance. We increase assets with debits. When we make a payment, we reduce it with a credit. Okay? So 120,000 net of the 50 gives us a $70,000 ending, and we may also just say BAL for balance, but it's the ending balance. Here's a balance BAL beginning. All right. So that's the impact on the cash account. Assets increase with debits and decrease with credits. Liabilities and stockholders' equity decrease with debits and increase with credits. You have to memorize these relationships. They are fixed in the accounting system, and if you get them backwards, everything gets messed up totally. For me, the best way to memorize it is you just have to memorize one. Assets increase with debits, then everything else is the opposite. Assets increase with a debit, so you decrease an asset with a credit. If an asset increases with a debit, then a liability increases with a credit. Okay? The other way to remember it, see if I got some blank space here, and I don't. I can put, I'll fit it in here. This is called a tabular balance sheet. So a balance sheet when you write it side by side. So this is the left. These are increased with right and right. Okay. But absolutely have to remember that assets increase with debits, liabilities increase with credits, stockholders' equity increase with credits. Okay, so that's a good place to stop. Get to know this, get comfortable with it. Assets increase with debits.